Everyone wants financial freedom as a concept, but not everyone really wants to get into it the way it's necessary to get something out of it. Thanks to inflation, getting your finances right is not a luxury anymore, it's a necessity. I don't want this video to be like a bunch of definitions of savings, assets, debt, and whatnot. I made it a practical guide that you can follow, something that you can pick up your phone and set up as we go along. So let's get into it. To begin, you need to self-diagnose your money health. The first money mistake people make is basing their finances on guesswork. If I ask you how much you spend on rent every month, your answer will likely be very accurate because bills like rent are fixed. But if I ask about other bills like groceries and gas, you likely guess wrong. A good financial foundation is built on facts and figures, not guesswork. So on that note, let's see how much you're actually bringing in every single month. Make a money in list of all your income, big or small. If you are a salary earner, it is easy because you already know how much you get paid every month. But if you are not, say you work hourly or your income fluctuates, you need to look back to like 3 months to 6 months and calculate the average. Once you have done that, the next thing to do is to make a money out list. Write down everything you spent. Visualize your typical day. When and what do you spend on? Is a big data plan, online shopping? You write it all down. I don't want you to think monthly year because not every expense is experienced by you on a regular basis. Go back 3 months to 6 months so you can see all your spending choices, not just the obvious ones. For example, here in Nigeria, we pay rent yearly. So looking back 1 month will most likely not reflect that. Note everything and write down how much you spend on each item on a monthly basis. In my own case, the amount I spend on rent on monthly basis will be 1/12 of what I pay yearly. To know how much you are bringing in every month, subtract your spending, that is your money out, from your income. This figure is what you have left to save every single month. Now, let's give your financial situation a name. Go back to your expenses and assign these categories. Assign B to all your bills, like expenses like rent, mortgage, car, repayment, loans, credit card, gas bill, like all your expenses. In fact, anything that you need to maintain health and safety of yourself and your family should be labeled B. Done with that? Now, label everything else C, as in cash. This refers to expenses like groceries, spa treatment, entertainment, eating out. It's not like they are actually cash only payments. We are just calling them cash expenses to keep things simple. Now, here comes the diagnosis. If most of your money is going to be expenses, you are probably not earning enough. You will need to increase your income, but we'll talk more on that later. But if most of it is going to see expenses, you have a I spend too much issue, which you can tackle right now. To tackle this, you have to reduce your expenses. This is why we label the money out list in the first place. Start with the C expenses. They are the easiest to control. You can skip online shopping for at least a week or two, cancel unused subscriptions, make a whole meal, make a list before going to grocery shop. Honestly, only you can know the best way to make that adjustment. So just do it. On to the savings you have left. How do you go about it? Now it's time to set things up. You need 2 checking accounts or your current account for bills and cash payments, plus 2 savings accounts, one for emergency funds and one for long-term goals. Before you ask, an emergency funds an account that should ideally have enough money stashed in it that will cover 6 months of your essential expenses, things like rent, food, insurance, and stuff. Many have said that the 3 months is a good starting place too. So, what about long-term goals? Well, if you are like most people, you have at least one pricey item on your wish list: a trip, a wedding, a house, a car, whatever it is. It's worth saving for. It's kind of give you something to look forward to, if you ask me. Your next question will probably be, how much savings to go into the emergency fund account and how much should go into the long-term goals account? Well, your emergency fund comes first. If you have some money saved up already, then you can move like 6 months of your expenses to the emergency fund account. But don't move the rest to the long-term goals account just yet. You do that after setting up your investment account, which we'll cover in the investment section. If you don't have anything saved up yet and your current saving doesn't make your calculated emergency funds, then you can move the savings, all your savings, to the emergency funds. Afterwards, whatever is left each month is going right into that emergency funds account. This is the most important part of setting up accounts. Try to automate as much as possible. This is not about setting up monthly reminders to remind you to make transfers. This is about setting up automatic deposits to the created account. It does not only frees up time, it also removes the possibility of human error. One more thing, this savings account should be add to assets. And I don't think I need to give you reasons for that. The flip side of savings is, of course, debt. It comes in various forms: mortgage, student loan, credit cards. To begin tackling debt, a subtle way is to change the way we talk about it. So instead of saying, I'm in debt, you could say, I have debt to pay. Debt isn't a place. Don't let yourself get stuck there. A common question people who doesn't have an emergency fund yet but also have some debt to pay usually ask is, which of the two should they address first? The answer is that while you should always make at least the minimum payment on all your debt, it's more important to start an emergency fund than it is to pay extra towards any debt. That way you don't end up accumulating more debt when an emergency arises. Another question that may arise here is, okay, I have my emergency fund sorted and I have long-term goals and debt to pay. Which one should I do first? With some credit card companies charging as much as 30% interest on outstanding balances and savings accounts earning about 1% in interest, simple math suggests that your money is better spent if you pay off debt instead of contributing to a savings account. That said, the best way to pay off your debt is to get a clear picture of what you owe. Make a list of everything you owe with the amount, interest rates, and due dates, then choose a repayment strategy. There are two popular ones, the snowball method and the avalanche method. Using the snowball method, you pay off your debt from the smallest to the largest. To do that, the first step is to automate all your minimum payments on all your debt, except the smallest one. All of it. I can't stress that enough. Because missed payments will have far larger impact on your financial situation. Future lenders will be less likely to give you a loan, and if you get one, the interest rate will be higher than it otherwise would have been. There's also penalty interest rates after 2 consecutive missed payments. So please always pay your minimums. Step 2, you put the savings you set aside for debt repayment into your smallest debt. After the debt is paid off, you move to step 3 and you apply all the money you put toward the first debt into the second debt, and then you repeat until all your debt is paid in full. The avalanche method, on the other hand, will have you pay off your debt with the highest interest first, regardless of the balance. The reason you do this is that you'll be paying off more expensive debt first. Though this is the most logical approach, the best strategy really depends on how you operate. You should try the snowball method if you are motivated by small, fast wins, and if you prefer long-term approach with bigger wins, the avalanche method will be a good fit. So here comes the age-long debate: good debt versus bad debt. Before I start qualifying, there's some debt as good and some as bad. You need to know that not all debt can be classified as good or bad. It often depends on your own financial situation and other factors. So let's classify. Low interest debt that helps you increase your income or your net worth is an example of good debt. Mortgages, business loan, student loan are usually considered good debt. Expensive debt that drag you down financially are considered bad debt, especially when used for things that lose values like cars, clothes, and consumables. Sometimes bad debts are just good debts gone wrong. Credit card debt is an example of this. If you have high interest credit card and pay off your balance each month, no problem. But if your high interest credit card debt builds up, you could be in trouble. And too much of any kind of debt, no matter the opportunity it creates, it's a bad debt. The next step is boosting your credit score. In a nutshell, your credit score is a computer-generated number indicating chances you pay back a debt. A good credit will get you the best interest rate and huge savings on anything you purchase with credit, a car, a house, whatever. The number you are choosing for in the US is 740, in the UK is 881, and in Nigeria it's 700. There are a few factors that impact your credit score. The most important is payment history, aka your ability to pay bills on time. Then there is credit utilization, which is the percentage of your credit limits that you use. I know the phrase credit utilization ratio sounds confusing. It's actually pretty easy to understand. It's the money you owe on your credit cards divided by your total credit card limit. Let's say you have a $500 credit card balance on a card that has 1,000 credit limit. On that particular card, you have used half of your available credit, giving you credit utilization of 50%. Your total credit utilization is the sum of all your balances divided by the sum of all your credit card limits. Or for example, if you have 2 credit cards, each with $1,000 limit, and you owe 500 on one, 250 on the other, your credit utilization ratio is 750 divided by 2,000, which is 37.5%. You should always aim to average under 30%, just enough to establish your credit history and make sure you pay off any balance every month. To quickly improve your credit score, try this tip. Pick a small monthly debt like your Netflix bill and get it charged to a credit card that has zero balance. This bill should be the only thing the card is used for. Now, autopay it each month after the statement closing date. By bringing one of your card's balances to zero every month, your credit score will jump. Now, we've gotten to the income part. If most of your money is going to regular bills and utility bills, then you need to increase your income because you are not earning enough. If you also feel like you don't have enough left for savings on a monthly basis, then you also need to increase your income. Though spending less is most of the time the quick and easy solution to financial crisis, there's a limit to how much you can figure down. On the other hand, there's no limit to how much you can make. The income side of the equation is where the real potential exists. There are a couple of ways you can increase your income, and one involves upgrading your current earnings as well as the other, which is hacking the side also. You can upgrade your income by asking for a raise or getting a new job that pays more than your current job. If you can't increase your current income through your primary job, then it's time to strategize a side hustle. An option for side hustle is to get into the gig economy, which is immediate short-time cash, service or sales. It could be dog walking, babysitting, housekeeping, helping small businesses with their accounting and bookkeeping that can make you money today. It's basically monetizing any of your talent. And this looks different from one person to another. For some health workers, it's private practice. For some cloud engineers, it's helping businesses set up their own cloud environment. So the reality of what this could look like depends on which skills you are comfortable and you want to offer for service. Another option is building your own business, which obviously will take more time than taking gigs. Whichever one you choose, putting a target on your side hustle will make it seem more real. A good starter goal is $500 per month, which is $125 per week, $16 per day. Now that you become financially stable, let's see how you can conserve wealth. Money is like plants. If you put it into an investing account, it will grow. This growth happens because of something called compound interest, which is when your money makes money, and then this money, that is the interest, makes more money. Basically, your interest earns interest. First, you need to invest for your retirement. In fact, investing for your retirement should be the first part of this video, because it doesn't matter if you are saving for emergency funds, if you are paying your debt. The first thing you do as soon as you start making money is invest in your retirement. Why? Because it's your younger self job to look after your older self. Retire comfortably when you are ready to stop working. That's why if you want to continue to work past the traditional retirement age, which is in your mid-60s, it's because you want to, not because you have to. Thankfully, most employment comes with a retirement account. You will ideally invest like 20% or at least 15% of your pre-tax income into that account. You can do this through your job provided 401k if you are in the US, or SIP if you are in the UK. A Roth IRA or a traditional IRA are also retirement accounts that you can set up yourself. The UK equivalent of a retirement account you can set up yourself if you don't have one from your job will be the ISA. In Nigeria here, we call them PFAs, which stands for Pension Funds Administrators. You can get one from your job, or you can simply open one yourself. A simple Google search for retirement savings accounts in my country will give you the available options. So, now that you've chosen your retirement account, it's time to turn your attention to something called investment mix. The technical term for investment mix is asset allocation, because it describes where you are allocating your investment funds. For the sake of ease, we'll only focus on two places you can invest your retirement money, which is stocks and bonds. What are stocks? Stocks are essentially a piece of ownership of a company. Think of a company as being a whole house made of millions of small building blocks. When you buy stocks, you are buying some of those blocks. Stocks have the potential to grow in value really quickly. They also drop in value just as quickly. This is because fundamentally stocks are driven by unpredictable factors like market demand, product sources, investors, interest, and many other volatile factors. This means that while there is a terrific upside with stock ownership, there is less guarantee of the amount you earn and more risk of owing them. Bonds, on the other hand, are a loan to a company. If you invest in bonds, you are loaning money to a company such as Walmart or a state like New Jersey. They use the money to run their business or complete project, then pay you back with interest. As an investor, you get more stability when you buy into bonds but less growth, obviously. So your mix is how much you have in stocks versus how much you have in bonds. Understanding your investment mix is important because it's basically the easiest way to manage risks with your retirement money. Generally, you want to be invested in both stocks and bonds. One can give you momentum in growing your investment, the other can provide you slow and steady form of growth. Let's say your retirement investment is a bike. Stocks are the pedals. If you don't have stocks, you are not going anywhere, right? The bonds are like your brakes. If you have all pedals and no brakes, you can crash, which is what happened in 2008 for people who didn't have the right mix. Likewise, if you have all brakes and no pedals, you'll be stuck. You want to figure out how fast you want to go and then create the right investment mix of pedals and brakes. It is generally considered smart to adjust percentage splits between stocks and bonds as you age. One general rule of thumb is called the rule of 110. Suggests that you subtract your age from 110 and then use the bigger number as your stock percentage and then the smaller number as your bond percentage. For example, if you are 30, that's 110 minus 30 will give you 80. That means you should invest 80% in stock and 20% in bonds. Next year, when you are 31, your percentages will be 79% in stocks and 21% in bonds. This is a strategic way to reduce risk as you get closer to your retirement. A target date fund is a solution. It provides an automated investment mix, so you don't have to deal with the math-aged thing. Many 401ks and big brokerages like Vanguard and Fidelity have target date fund. Although it comes with higher fees, if you want to do it yourself, you can make it a habit to recalculate the 110 rule on your birthday, or maybe the second day of your birthday, whatever. Sadly, in Nigeria, due to regulations, you can only have up to 30% of your retirement funds in stocks. Simply check Google if there is an option of something like the target date fund in your country. If you are looking to retire early, you'd have to be a little bit more aggressive towards your retirement savings. And the number you are looking for, that is how much do you need in your retirement investment, is your annual expenses multiplied by 25. Once you have that in your retirement investment, then you're good to go. The total is what you need to be as comfortable as you are now with the help of the 4% rule, which says that a person with 25 times their annual expenses invested in their retirement will never run out of money. If they only withdraw 4% or less money from their retirement account each year, this even accounts for inflation over time. The reasoning is based on the fact that the annual market rate of return is on average greater than 4% year after year. For the last 30 years or so, it has yielded around 7% to 8%, inflation adjusted. Let's say an example. If your expenses are $50,000 per year right now, and if you multiply that by 25, you need $1,250,000 in investment. If this money yields 8% a year while you are in retirement, it will be earning you around $100,000 in interest annually. Ideally, you only spend half, which is 4% of your interest earnings each year, which conveniently amounts to $50,000. That will leave you with $50,000 for your annual expenses and $50,000 reinvested into your principal. As usual, set up an automatic transfer into your retirement account. That's if you have to set it up yourself. But if the account comes with your job, that will be done for you already. After you started investing in your retirement, your next step is to invest in wealth. But before you start investing for wealth, you have to have met some criteria. Number one is you are on time with your bills. Seriously, it wouldn't make sense to be short on your bills while you are trying to invest. Number two is you are making consistent contribution to your retirement account. Ideally, you should also have 6 months of your expenses saved. That's number 3. Number 4, you will be investing money that you won't need over the next 5 years. That's number 4. You want to give yourself more than 5 years to see return on stock investing. That doesn't mean that you won't see results, that is profit sooner, but fluctuations in value are part of the market and it often takes longer to benefit from average. So you want to think of the money you are investing as cash that you can't afford to have out of your hands for at least 5 years. Number 5, you have paid off your high interest rate debt. There have been questions on whether you should invest if you still have debt to pay. To answer that, over the last 100 years, the stock market has historically averaged a 10% annual return. But over the last 30 years or so, the return has been closer to 7% to 8%, which means it's unlikely that you will outperform your double-digit interest you are being charged on any debt, credit card or otherwise. So pay your high interest rate debt off before you start trying to earn through investment. Okay, you tick all the boxes. How do you start investing? Even though there are countless of ways to invest your money, ranging from real estate, stocks, bonds, NFTs, crypto, art, even watches, all of these can get pretty complicated very quickly. But for the sake of simplicity, we will stick to stocks and shares because this is the main part of investing that normal people like you and me can unlock fairly easily. With stocks, you are basically buying a portion of a company. To buy a portion of Facebook, for example, you don't go to facebook.com to do it. You do it through the middleman called broker. Through brokers, you can purchase any stock of any publicly traded company available. This means the public can trade this company's stocks. That begs the question, how are you going to choose which company to put your money on? I mean, we are not like financial analysts that burns 50 hours every week trying to figure out which company will do well. So yeah, picking stock is not an option for us. What you can do is to invest in index funds or mutual funds. This is not a financial advice though. Let's get some jargons out of the way first. Securities is the catch-all term for all types of investment that you can buy and sell. Mutual fund is a collection of or basket of stocks, bonds, and other securities from multiple sources, usually managed by a professional. The aim of most mutual funds is to beat the market, and because of this, the management fees, which is called the expense ratio, is usually higher. An index fund, it's a fund in which investments closely track a particular stock market index. It's more of a statistical measure in security markets. It's basically the representation of investment of one segment of the whole market. An index fund's goal is not to beat the market, but to mirror or match it. As a result, most of them are passively managed, that is, investments are automatically selected by a computer, not human, which means lower management fees for you compared to mutual funds. Index funds mirror the market with all sorts of diverse companies. An example is S&P 500 index, which is the top 500 biggest companies in America. This index currently includes companies like Best Buy, Kroger, Amazon, and so on. It is considered to be the best representation of the US market. If the value of these companies is slowly increasing, which it generally does, then so is the value of the whole American market. Over the past 30 years, S&P 500 index has delivered a compound average annual growth rate of 30.7% per year. When you invest in index funds, you are investing in bonds that will mirror the performance of the market. Another example is the Dow Jones Industrial Index, which groups together the prices of 30 most traded stocks on the New York Stock Exchange. A few companies such as Coca-Cola appear on both S&P and the Dow. There is FTSE100 index in the UK, which tracks the top 100 largest companies in London Stock Exchange. There's also NGX30 in Nigeria, which tracks the top 30 largest companies on the Nigeria Stock Exchange. So you know which fund to invest in, but how do you buy it? The easiest and the most cost-effective way to do it is through online broker for stock trading. You might want to be sure you choose the one that is registered and licensed to operate in your country though. On the stock market, you will find all mutual funds and index funds that can be traded, and then you get to choose which one to put your money into. You can also use robo-advisors. They provide financial planning services through automated algorithms with no human interventions. They start by gathering information from you through an online survey. These surveys are usually centered around your goals for the investment and then automatically invest for you based on the data you input. You could also use personal financial advisor if you want a fully customized financial plan beyond investment, like insurance, debt management, college planning, and ongoing management of all your assets. The caveat is that this extra level of attention comes at a much higher cost. Currently, fees range from as low as 0.03% for passively managed investment like the online brokerage firms to 2% or higher for actively managed investment. As a rule of thumb, the more human interaction your money gets, the higher the fee you'll be charged to manage it. Now you know how to buy, you know where to buy, and you know what to buy. The question is, when should you start buying? You may be tempted to wait to buy your selected funds when its price go down. There's a name for that. You are trying to time the market. But we want something hands-off. We want something we can set and forget, at least partially. Part of ignoring the noise and choosing to invest based on something called dollar cost averaging instead of trying to time the market. The history of investing shows that you will do better with the dollar cost averaging, which is when you consistently invest a set of amounts into the same stock of funds at a regular interval. For example, you might decide to invest $50 every month, regardless of the current value of the index fund you've chosen. If you were to do this, the average will give you better results than if you had tried to guess when to buy in. So by now, I think you know what next. Set up an automatic deposit to your brokerage account or robo-advice or whatever you are using. Next up, insurance. Insurance is tricky. It can feel like a waste of money until you need it. And then if you don't have it, you could be in real trouble. First, if you don't already have it, get a health insurance. Employers usually provide a few options. If you are self-employed and live in the US, healthcare.gov is a good resource for finding the right policy. If you are not in the US, make a field trip to Google search and search for affordable healthcare insurance in your country. You might also want a life insurance that provides a lump sum payment to your beneficiaries if you die. You don't need a life insurance if you are single or have no financial dependence or much debt. But if you have a spouse, children, or major debt, you need to insure yourself for at least 10 times your annual income. If you can afford it, get a disability insurance. It covers you if something happens and you can't work. In the next video, I'll talk about how our future could look like with the presence of advanced medical technology. So please do check it out.